All right, good afternoon, everyone. I'm Holly Schoenfeld with U.S. Global Investors. Welcome to today's webcast. Will gold win the Trump-Biden knockout? Well, yesterday was Election Day in the U.S., a much anticipated day for many Americans. We're halfway through Wednesday, and we still do not have a declared winner, but as we'll hear in today's webcast, it's not just about blue versus red, it's about gold. I am pleased to welcome today's presenters who will believe that the yellow metal is the real victor here. Frank Holmes is CEO and CIO of U.S. Global Investors, and he will be leading today's discussion. And joining him is special guest Robert Moriarty, founder of 321gold.com, which is an incredible resource for those interested in the gold space. So, without further hesitation, I will hand it over to Frank, who will take us through this journey, and if there is time at the end, we will open it up to a brief Q&A. Frank?
Thank you, Holly, and thank you, Bob, for participating in this. And let me give you an idea of the genesis. I kept being asked questions, and the question was, are you a Republican? Are you voting for Democrat? Who do you think is going to win the election? And I said, I'm not pushing the red button, I'm not pushing the blue button, but I'm pushing the gold button. And it really doesn't matter what they're going to do, who's going to win in the political party. It's about government policies. They're the precursor to change. And we're going to try to talk about all the unprecedented money printing. And then we're going to try to really make it an educational. I'm so happy Bob is on here because he has incredible experience in the exploration stories, and he visits properties all the time. And really recently, he was with Ralph Aldis, our gold analyst. And I think you were in Brazil together. So Bob is a road warrior of looking at plays and sort of make this educational, understand the gold cycle, what the drivers are, and some great take-home value for you. But as always, it's always about perspective. So this visual is always related to me, and I love it because here you have a sphere, and it can be a circle or it can be a rectangle. And light changes our perspectives. And so we must all have an open mind. Next, please. You change this, thank you. So the top performing precious metals in 2020, it's been silver. Silver has surpassed gold, especially when we look in July, August, and historically, this is what's taken place. Silver has been a warrant on gold. Central banks don't really keep silver, they keep gold. However, silver seems to have a greater volatility. And historically, a 10% move up in gold can all of a sudden trigger a 15% run up in silver. A 10% correction in gold can have silver drop 15%. So it's important to recognize that silver is a phenomenal precious metal, but it's much more volatile than gold. Next, please. Thank you. All asset classes have their own DNA of volatility. And it's just so important for investors to really understand that concept. So this is a simple visual that shows you the daily volatility of gold and silver. That means 70% of the time, it's a non-event for gold to go up 1% or fall 1%, and the S&P is same. So when I get on these television interviews and they're so negative on gold and gold's more volatile than the market, it's just not true. As you can see here, over 10 days, it's plus or minus 3%. Over 1 day, it's 1%. What's important for traders is that when it goes up 2%, 3% in a day, you got to take profits. If it falls 2 or 3% a day, mathematically, odds favor a mean reversion. And now when we go to the gold stocks, their volatility is just much greater than bullion. That's where the volatility triggers in. And the most volatile is oil. I mean, oil is just unbelievably volatile over 10 days, over 1 day. And Bitcoin is in fact less volatile than oil. So for investors, when you're traders, when you're looking at this asset class, what we find is that gold stocks correlate and trade over 94% of the time on the direction of gold. So if gold is up 1 sigma, the gold stocks can be up 2 to 3 standard deviations. And when you're in a secular bull market in gold, the juniors and the explorers can be up 5 or 10% in a day. It's just really respect this volatility, and it makes it easier to participate in this wonderful industry. So another look at silver's volatility. Historically, it's been higher than gold. As you can see here, when silver hit $50 an ounce, and the ratio went to an all-time low with gold at $850 in 1980, when the Hunt brothers caused silver to explode. Well, this just basically is giving you an idea that we're still not even there on this recent silver move of what can take place. Where that silver gold ratio is an important part of looking at the trade-off between a silver stock and a gold stock. Next, please. The other part, which always shocks me, is the basic negativity inherent on CNBC New York in particular of gold as an asset class. If it's had a great run, oh, it's gone too far. If it's had a correction, oh, it must be going to fall further down. And try to point out to them that 80% of this century, gold has been an outperformer. 80% of the time, it's been up. And in fact, in the next visual can highlight the significance of this, is that the it's basically outperformed the S&P 500. So here we see gold, and this is a classic of showing you that gold is up 3 times greater than the S&P 500 this century. And you just wouldn't think it. I read research reports for the major wirehouses and the brokers. It's still this sort of negative view on the asset class. However, when the largest hedge fund in the world, Ray Dalio's Bridgewater, always has an allocation towards gold, and that's probably helped his investment thesis of rebalancing, calibrating every quarter. So this is a visual going back in 2016, and once again talking about why gold, with the risks of gold, not where the opportunities are in the portfolio and where the risks are in the overall market. And this is a great rudder in a sailboat. It's really, to me, important for investors to recognize gold has been a stellar performer, and I believe that it's going to continue to be a great performer. And it really doesn't matter who's the president of America. The real big issue that I see is this expansion of monetary, this idea of what's called MMT, modern monetary theory. The idea and the concept of using monetary levers to drive an economy. And each time there's a big correction, it just requires trillions of dollars more. It used to be measured in billions, and now it's trillions to move the dial, to turn around an economy that's gone through a big correction or any serious recession. Or like now we have COVID. It just is, it's unprecedented the amount of money. So gold will continue with this money printing as a great asset class. Next, please. So the S&P performance in better years is when the incumbent wins. And basically, it's basically saying to you that 87% of the time, the president gets reelected. And to me, I come back to what's taking place right now. Gold is off. Basic materials are basically negative on a relative basis to what some of the other asset classes are doing. It doesn't matter because, as Pim Fox just wrote on Bloomberg, that if you go back the past 50 years, if the market's up going into the election, then historically it stays up for the month of November and to year end. So don't get bearish. All these analysts that were pro Biden was going to win and Trump was going to lose and these asset classes, it's amazing to see all these research reports come in and they reverse themselves. Don't get caught up with the noise. It's nothing to do with who the political party is. It has to do with their policies and their management of the economy. That's what really drives the stock market. And as you can see here, each president just continues to push. They have the debt ceiling lifted, and now they're tinkering with more and more of this MMT, which is only going to make it more exasperating, and gold is an asset class around the world. Next, please. So I've been commenting on and looking back at the recent corrections we've had and what took place after 2008, 2009, and how the Fed balance sheet expanded. And what does that mean, that level? So how many trillions went in to turn the economy around after 2008-9 bottom, which happened in March of 2009? It took $3 trillion of federal balance sheet, Federal Reserve's balance sheet expanding, and a $700 billion fiscal stimulus by President Obama to ignite the economy. And what's important here is how much is dealing with now COVID-19 and what's the Fed expansion of their balance sheet today and what is that difference? So I hope some of these visuals are going to highlight to you that I personally think in the next 3 years, gold could easily be $4,000. And there's a rational reason. It's this excessive money printing. So here it's not just America. It's the world, and in particular the G20 countries. They're all playing with this MMT as a way to continue to deal and stimulate the economy. And you can see that China is an incredible run in printing of money, along with the Eurozone, Japan, and the U.S. Next, please. The Fed bought muni ETFs, driving interest rates down. What happened in March is the Federal Reserve dropped interest rates, but it didn't trickle down. It didn't show up in the muni market, and it didn't show up in corporate bonds. So when you have $1 trillion market, and many of the school systems and sewage systems and infrastructure by states, they're rolling over their debt every month, and all of a sudden rates start to rise. That's what took place outside of the Federal Reserve, outside of the Fed rates dropping. You saw mortgages drop, but you didn't see that happen in the corporate world or the muni world. So what's really different is the Federal Reserve started buying ETFs in the muni business. And what did it do in buying them? It drove down muni bond yields. How did that help? It helped municipalities roll over their debt at a cheaper rate. Further, then the Federal Reserve came in and started buying corporate bond issues. That drove down, and what I give you a classic example, friends of mine were organizing on their real estate, a rollover of debt was going to be around 6%, and all of a sudden it spiked to 14%, even though Fed funds had fallen. And so therefore, that meant that in the real free market of the cost of capital, it skyrocketed. And banks were afraid to lend money to corporations, and banks were being more concerned, even the municipalities. So what you had to do is get those rates down. The Federal Reserve is now using ETFs as a mechanism to do that. This is new here in America, but not in Japan. The Japanese market, 15% of their stock market is owned basically by their central bank, who prints funny money and goes out and buys a good quality assets. The same thing is happening in Switzerland. Now the Swiss ends up buying stocks like Apple, and they float negative real interest rate bonds, which is great. Then they go buy real interest rate yields. So what you're seeing during the secular bull market in gold, which I like to point out started in January 2019 with the infamous golden cross, where gold, the 50-day moving average went above the 200-day moving average. You still had pervasive negativity towards gold, and in particular gold stocks, whereas gold slowly was climbing this wall, and you started seeing the G20 cartel of central bankers and finance ministers working on globalization, and you can see what was taking place in these previous cycles. So we go back to 2001, we saw the G20 finance ministers really consumed with policies for synchronized trade and growth. After 2008-9, it became synchronized taxation and regulation. The operative word, let's harmonize taxes and regulations globally. That was basically to raise regulations and taxation. What we're seeing today is a battle against COVID, the invisible World War III. And fighting this is basically the countries all working together and allowing unprecedented money printing, and that allows them to turn around, and you can see them basically buying real assets, especially the Swiss, the Japanese. So let's stay tuned the secular bull market, because it's important, because the secular bull market started in 2001. It ran all the way up to 2007, 2008. So I believe we're still in the early innings of a secular bull market in gold. Now, gold can fall below that 50-day moving average, but it's going to take a long-term severe correction for the 50-day to go below that 200-day. So I remain constructively very bullish. And what's interesting is that many of these billionaires, as you can see here, they were speaking about gold as an asset class, and most people were negative on CNBC, trying to disagree with them. And it really started to pick up after the golden cross. Next, please. Next slide, please. Thank you. So gold historically has rallied on periods of high inflation, but I get this call all the time. There is no inflation. Next, please. However, there's a great piece of research by John Williams, and John Williams has gone back and used the algorithm that was used to determine what the CPI number was in 1980, when gold hit $850 and silver hit $50 an ounce, and inflation soared over 15%. What was that algorithm that made that determination? To be applied that today, inflation is like 8%. So yes, there is inflation. And it's just a joke to say inflation's at 1.3% when we all know the gas pump inflation has bottomed and it's up substantially. We know that real estate across America, housing is up over 10%. Lumber is up 40%. So we do believe that the calculation for determining inflation, that where we predominantly spend our money, is actually much higher. So gold is even now more attractive than ever as an asset class. Next, please. It's always important to remember this inverse relationship with yield, real yields, and gold. As you can see, when real yields are rising, gold falls. When real yields are falling, gold rises. When you look at the global debt and you look at what percentage of real negative real interest rates is another factor that would drive gold. That's the fear trade. And what we're seeing now is this sort of unprecedented belief that the Federal Reserve will print aggressively, printing money to maintain the economy. And this is very important for an asset class of real assets. And the fourth most liquid asset class in the world is gold. Now, this is another visual giving you an idea about the love trade. And this is a correlation of showing the GDP growth of China along with the gold price. And they're highly correlated. And this what drives the consumption. And if you go back to 1989, 1990, China and India, affectionately known as Chindia, consumed about 10% of the world's gold. Most of that was out of India. Now the GDP per capita, the purchasing power parity of China is grown much faster than for China than India. But nevertheless, what's important is today they now are 40% of the world's population, but because of a cultural affinity towards gold, they're 53% of all gold demand. That's an underlying sustainable demand. And that doesn't fluctuate that much. It just grows with GDP per capita. The fear trade is the other element that moves gold in these big surges. And that's the added fuel to this development. Recently, I was asked to go on to talk about why I thought gold could go to 4,000, and this was in early August. And basically everyone was negative except for myself. And I said, short term, gold could easily correct. It's had a wonderful move, but long term, basically based on what I just shared with you, the expansion of the Federal Reserve's balance sheet is gone not using 3 trillion, but is 7 trillion, and it's probably going to grow now to $10 trillion. This is a case study of looking at 2008, how much the Federal Reserve's balance sheet expanded, and how I believe this helped drive the price of gold. Now we go today, we're going to be pushing the Federal Reserve's balance sheet is $7 trillion, and possibly I think it's going to happen is go to $10 trillion. Next, please. What's important here is everyone criticized Alan Greenspan when he retired that he expanded the balance sheet too great, and it was 6% of the GDP. Under Jerome Powell, it's now 33% of the GDP. So this is a classic example of MMT. One hand is that Powell says he doesn't believe in it, it's not using it, but when they send checks to everyone to keep the economy going in April and May, there's no doubt this is an MMT experiment. Next, please. So now I want to talk about really the superstar of today is my good friend Bob Moriarty, and I'm so pleased to have him on with us because many of you are familiar as a founder and popular website 321 Gold. He's also the author of a number of highly rated books, including Nobody Knows Anything About Investing Basics, and recently Basic Investing Resource Stocks, The Idiot's Guide, both available on Amazon. And I think what's really also important that some people are not aware that he's a very distinguished combat pilot. In 1965, he became the youngest naval aviator at the age of 20 and was a captain by the age of 22. And during the Vietnam War, he flew more than 850 combat missions. Remarkably, he still holds a time record for flying from New York City to Paris and back. In 1981, 3 years later, he famously flew his Beechcraft, as you see here, underneath the Eiffel Tower in his Bonanza B-35. Bob, thank you for joining us.
Yeah, I don't know anything about that. I don't know how you fake that picture. Good to be here. Okay, what would you like to talk about, Frank? Ah, this is really interesting. Frank and I were talking about this. Frank asked me who was going to win the election, and I said Trump. And he was actually very surprised. And I said he should get a list of the social media followers because those are voters. And if you look at social media, Trump is obviously much more popular than Biden. And when I wrote the piece 2 weeks ago, talking about the webinar, we did say we wouldn't know necessarily who won the election. And now it looks like it could be weeks before we know, which is pretty scary. And next.
And just to add, my thoughts were that Biden was going to win because he threw much more money at the campaign and was able to raise much more money, basically $1 billion.
Well, we have an ongoing coup that's gone on for 4 years, and the mainstream media and the deep state, the Democratic Party, they have the Russian collusion, and that was fake. They have the impeachment, and that was fake. When they came up with Hunter Biden's laptop, first thing they said was the Russians did it. We're in a very scary area. Frank didn't address this, but the United States is in a very precarious position politically. And only time is going to tell how it works out. But it is interesting. Biden outspent Trump by 50%. Next. When you want to invest in individual stocks, there's something that you should go through. And I'm going to go through this quickly. You have the team, you have the political jurisdiction, you have the quality of the project, you have the success or not of the team, and you've got the business plan. But actually, this is the last thing you should do. Frank and I were talking about this yesterday, and one of the issues is I think there's about 1,200 juniors in Canada. Now, if that's true, and you spend 15 minutes evaluating each company, it would take you 300 days to actually, or I'm sorry, 300 hours to actually look at each project. And of course, by the time you have done that, it would have changed. So what is actually more important as far as I'm concerned, and I do talk about it in the books, is where do you stand in terms of, are we in a bull market or are we in a bear market? In a bull market, everything goes up. And in a bear market, everything goes down. One of the things that people miss, let's go to the next slide. Oh, I like this a lot. These are pet phrases. And if you hear them, if you go to a gold show, or if you go to their literature, if you go to the website and you see this, you don't want to invest. Okay, let's go to the next. I wrote a book about Novo Resources. If you go to Commodity Collector, we're a junior exploration company focused on precious metals, base metals, diamonds in North America, South America, and Africa. Artemis Resources was in the nickel business, and the cobalt business, and the copper business, and the gold business, and the silver business, and the nickel business, and the diamond business, and to cap it all off, they had a graphite project in Greenland. And my comment was there isn't a single major in the entire world that does every one of those projects. So if they couldn't do it, you can't do it. Next. The management team is important, but I think the real key to it is track record. We have been in an overall bull market since 2001. So people have had 20 years to succeed or fail. If the guy has failed for 20 years, don't invest in the company. If he's succeeded multiple times over 20 years, it's worth doing. Next. In this book, I try to break things down so they're simple. If you look at the social media between Trump and Biden, that's a really simple issue. Trump has 8 times social media that Biden has. So if it's a true, fair election, which is not necessarily true, Trump should win. When you're looking at stocks, it's pretty much as simple as it's in one of 3 different categories. It's either cheap, and I'm going to show you an example in a minute, and that's a good time to buy if for no other reason than it's cheap. And then it gets expensive, and that's a good time to sell if for no other reason than it's expensive. And every 20 years or so, you get a fairy tale price. Now, my belief, and I'm absolutely fixed on this, we are going to go into hyperinflation. We have a greater increase in the money supply in the United States today than Germany had in 1922. And of course, they were going into hyperinflation. When you go into hyperinflation, you can no longer price things in dollar terms. We don't talk about gold in terms of the Zimbabwe dollar because the Zimbabwe dollar is a fairy tale. I think there's an excellent chance that gold is going to go to values that people have never dreamed before. Now, I don't pick price. I can't do it. I do not have the talent, but I'm sure it's going to go higher relative to the dollar, and it could go far higher. And I think eventually it's going to get to a fairy tale. So if you didn't sell when stuff got expensive, you do want to sell when it turns into a total fairy tale. Bitcoin is a perfect example. Tesla is a perfect example. Hertz is a perfect example. Now, I had written up a company called Maple Gold, and that's 1st of November in 2019. Maple Gold would sell it for 7.5 cents. That put gold at $3.02 an ounce. And quite bluntly, if you can buy gold at $3 an ounce, that's a good deal. They redid their resource estimate, and the resources were lower, but higher quality. And I wrote about the company again, and the company was 9 cents a share. Now, if you look from November of 2019 until today, it actually got to 4 cents a share in March. Now, I advocate if you buy a stock and you've evaluated it fairly and nothing has changed except the price, if the price goes down, buy more. And I know very few people agree with that. But if you go into your Porsche dealer and say, how much is Porsche? And he says $80,000, And you, so I'm thinking about buying one. I'll come back next week. You come back the next week and you say, how much is the Porsche now? And the guy says, well, we got a sale on is $60,000. And you say, well, gee, I don't want to buy it. There must be something wrong with it. It's cheaper than it was a week ago. Well, when you go into a Porsche dealer, you don't act that way. But when you buy stocks, you do. If the stock goes down, you don't want to own it anymore because it's gone down. But Agnico Eagle came to Maple, realized they had cheap gold, and in early October did a deal with them. From March of this year until a week ago, the stock was up 1,100%. If you do one or two of those trades in your lifetime, you can make a lot of money. And this is exactly what I advocate in my books. I am not an expert, but I've been around investing for 50 years. And I tell people exactly how to do exactly the same thing. And I was buying Maple at 7 cents a share. I bought more shares when it was cheap. And obviously, I'm riding on some substantial profit. Okay, next.
So I was going to jump in here, coming back, can we go back to the visual we just had where Bob was talking about his investment in Maple Gold? So what's interesting, Bob, about this is that that you are buying Maple Gold for $3 an ounce is basically the valuation of the market cap for the amount of ounces they had. You paid $3. The cost of exploration today is $30 to find an ounce. So you're still buying at a big discount from a development, and takeovers are done over $100 an ounce. So that was a very shrewd move, and where you said looking to buy cheap stocks, if you can buy stocks very inexpensive that already have ounces of gold on them, what I believe to complement what he's saying, what we're seeing from the majors and the mid caps like Agnico Eagle, they're just hungry for them to look for these types of projects. It's less expensive for them to go and become a strategic investor and to unlock these ounces of gold than it is to go and just do grassroots exploration themselves, because most major discoveries have been by junior explorers. Next, please.
Well, the key there, and it is something that I emphasize in the book, you don't have to make this stuff complicated. It's good to go through where it's located and what the resource is and what the management's like and what the history is. But the mere fact that something is cheap is a good indication it's time to buy. And the mere fact that it gets expensive is a good indication of when to sell. Now, this is, I think this is your slide, isn't it?
Yes, it's mine. And we both know Kirkland Lake's story. And just for those who are not aware of it, Kirkland Lake was a great investment during the bear cycle and the past 18 months for Eric Sprott. And Eric was a major substantial shareholder and chairman. And this company basically went to one of the highest grade producers in the world, and it grew. So what you saw even during a bear cycle in gold, its revenue per share was growing every quarter. Its cash flow was growing. In fact, it had a free cash flow yield, and the quant world was buying, not the gold investors specifically for gold. They just buy growth in revenue last quarter over 4 quarters, cash flow last quarter over 4 quarters, and has a free cash flow yield. They buy. And Kirkland Lake has shown up in Investors Business Daily, along with companies like Franco-Nevada, as a growth stock story. What's interesting here, and the reason why I wanted to break it up, is that this past year, Kirkland Lake, a year ago, made an acquisition called Detour. Now, Detour had a substantially lower grade than Kirkland Lake, and what happened is it increased their average cost of producing an ounce of gold from being one of the cheapest in the world. Now they're up more expensive. And it also impacted how their revenue per share grew, as you can see here, which is still spectacular growth, but their cash flow actually declined. And immediately, this is a stock that is just gone sideways. So what makes Kirkland Lake so appealing today is when gold breaks out and makes a new high above 2100, leverage gold plays. And the reason why I would ask Bob, I picked this one is because Kirkland Lake was a very high grade, beautiful gold producer like Goldcorp was back in 1999, 2001, 2002. During that period, it was extremely an incredible company, Goldcorp. Now Kirkland Lake became the next big winner of that. And so now they're going to go sideways. They're going to become highly leveraged, not with debt, but it's basically because their marginal cost is so much higher. And as gold starts to rocket through 21, 22, 2300, their profit margin will then start to expand faster than the others. And this becomes like we used to trade the South African gold stocks this way. They're extremely leveraged to a rising. So higher cost gold producers can have explosive moves on the upside. And that's why I picked it, Bob. We talked about leveraged gold stocks.
Yeah, well, let me interject this. The deposits that made Kirkland Lake so successful was the Fosterville mine in Australia. And the Swan Zone there, they can produce gold for $135 an ounce. They have the lowest cost of gold in the world. And it's an absolutely brilliant move on their part to expand into gold projects with much higher cost of gold, because you're absolutely correct. If they got into a project that required $1,500 gold, at $1,400 gold, it's losing money. At $2,000 gold, it's making money hand over fist. Now, I talked to Rob McEwen at Goldcorp back in 2001 when he actually went to gold shows, and he was bragging about producing gold at $80 an ounce. And I said, Rob, I tell you this, that's total bullshit. What are you doing? Okay, if you're producing gold at $200 an ounce, you're going to be the only company in the entire business, and nobody's going to care. You need to go out. You believe gold's going to go up. I believe gold's going to go up. You need to pick up a bunch of projects that are going to cost more money. Leverage is important, and the reason Maple Gold was so attractive to Agnico Eagle is maybe they weren't profitable at 1,500, but at 2,000, they are literally a gold mine.
Thank you, Bob, for that insight. Now I want to take a look at Seabridge, and Seabridge is one of those amazing stories where the CEO, when the gold mining companies 20 years ago were having difficulty, and he bought a bunch of gold deposits out of the money. That is, you needed much higher gold prices for these big deposits to kick in to be valuable. And I believe the math is he bought all these assets for $800,000, and today they're over $1.3 billion. Now, there's no production from Seabridge. It's nothing but one of the companies with the most ounces per share. And so when the price of gold starts to take off, as it has from the bottom of March, as you can see here, ASA, which is a closed-end investment gold company, this is the New York Stock Exchange, it surged 133% from those lows. And what you saw with Seabridge, it's up 218%. So this is a sign of more speculative money coming into the gold sector. People feeling a little more confident, people looking for out-of-the-money optionality on higher gold prices. So many of these assets at Seabridge, gold hits $5,000, this stock can be up tenfold because of the sheer optionality it has. Do you have any comments on that, Bob? Can we go back to that slide?
Yeah, let me interject one thing, and we talked about this yesterday. I was in gold stocks in the 1970s. There was one stock that went from 25 cents to $400. Now, when we were talking about Kirkland went in and found a magnificent deposit in Australia. Kirkland went from a $1 stock to $67, I think is the highest they got. Eric Sprott personally made $1.5 billion out of his investment at Kirkland Lake. And I'll be real candid. We are going to see stocks go from 25 cents to $40 or $100, maybe 400.
Next, please. But those stocks, you just always remember what Bob talked about earlier. You got to make sure who's promoting the story. That's not closeology and so some of the other caveats of risk. In he try to give you here's the checklist as a fighter pilot. And Bob, you know so well the three things a pilot has to have: an approved flight plan, a checklist to take this puppy up in the sky, and a checklist to land it. And so the same thing applies to picking mining stocks. You need a checklist before you buy it, and you want a risk checklist before. Go ahead, Bob.
Well, there's only one more comment, and as a fighter pilot, I should interject this. The only time you know you've got too much fuel is when you're on fire.
That's for sure. That's a good risk.
Hey, Bob and Frank, just a quick reminder, there's about 15 minutes left in the presentation, and we're really enjoying the discussion. Just wanted to give you that heads up.
Thank you. Thank you. Well, now I'm going to jump into the 5 M's of mining. There's the 5 pillars, the way Bob was looking at it. I'm going to give you the 5 M's. What's the market cap? Why is it worth that? Management, what's their track record? Money, what's their burn rate? What's their track record in spending that money with management? And what mineral? If they have too many minerals, forget it. Are they focused? They have success. These are very important parts. And to start it off with is where are they on the life cycle of a mine? Next, please. This is Pierre Lassonde covered these 5 M's of mining in his book, which is basically supposed to be reprinted of understanding where you are in the life cycle. So when we look at greenfields, discovery speculation, only 1 in 2,000 properties will find something that's commercially really attractive. Very few even find 3 million ounces. So it's highly speculative, highly risky. So you have to really understand what you're doing when you're playing the discovery speculation. And then you have the next is the brownfield. The risk starts to drop. Is it development? Does management, are they able to raise enough capital to develop the resource? Otherwise, the ounces get diluted with financing after financing. And that's something we've seen in our own quant models, that a lot of companies raise so much capital that they never really got the brownfield done, and the number of ounces they had at the beginning were next to nothing at the end. So the stock declined. And then you get to the production. And that expansion of production is really key to seeing a re-rating in stocks. Next, please. So here we have bet on the horse, not bet on the jockey, not the horse. And you know, this is showing you gold and silver. It's interesting, but I use this as an example because there's an Eric Sprott line and that he's often said when it comes to exploration, he doesn't bet on the horse, he bets on the jockey. What's the track record of management? What's their ability to raise capital, spend capital wisely, develop deposits, etc. So often when the more speculative you go, it's most important that you really focus on who the jockey is. Next, please. So another greatest jockey in the world when it comes to investing, the Oracle of Omaha, but he's not perfect. He's missed gold, Bitcoin, and Amazon. It's interesting, but still, he is a phenomenal person. He turned 90 this year in August. But I think it's important to recognize that in the past 20 years, next slide, please, Berkshire Hathaway is in fact underperformed gold. And so I've always found that fascinating. And he said that he doesn't pay a dividend. And he said that why buy gold? It doesn't pay dividend. Well, why buy Berkshire? It doesn't pay a dividend. And holding one asset class as a protection against inflation, real or perceived inflation, gold has been a better performer. Next slide, please. So the swarm concept is an important part when you look in the quant world of aggregating. And what you're seeing now, the fact that Buffett bought Barrick. And what's interesting for all the viewers is that Barrick and Newmont and Yamana and many of these gold producers are now talking about their free cash flow yield. That really is attractive to the non-gold fund investor, the generalists, who have substantially bigger pools of capital. And this was a sea change, a real important change of all of a sudden a gold stock being endorsed by Warren Buffett. Next, please. And if you haven't read the book, The Wisdom of Crowds, I highly recommend it because it basically goes in the concept of understanding that in the past 20 years, if gold has done such a great performer, and you still have this negative narrative of media and out of Wall Street main brokerage firms, etc. This is an asset class that defies that. So you have to look at really the wisdom of crowds data. Next, please. So gold is outperformed, as I mentioned. Look at this year. As you can see, with the COVID knockdown, gold has outperformed Berkshire Hathaway. Next, please. Is outperformed since the year 2000. This is a shocking number for a lot of people when I try to bring it to their attention that the greatest investor in the world missed this incredible asset class. But now all of a sudden, he says he wouldn't buy gold, but he bought a gold stock. Next, please. One of my favorite stocks has been Franco-Nevada, the biggest royalty company in the world, the pioneers in the royalty business. And as you can see, since they were public during their public tenure until the year 1999, 2000, when they merged with Newmont, they had outperformed Berkshire. Then they were quiet until 2008. They did a new IPO. They went separated from Newmont, and they've outperformed Berkshire Hathaway. So this is a sweet business, highest revenue per employee in the world. A champion. This is Pierre Lassonde, the person who created the GLD, the visionary when he was the chairman of the World Gold Council. Also the co-founder, along with Seymour Schulich of Franco-Nevada, developed the concept of buying royalties, which Seymour encouraged, which he learned from buying for oil royalties, then applied to mining, and now we have buying streams. So it's interesting to see that he did a great presentation last year in saying that going back 30 years ago where gold was and why it could go to 25,000 is rational reasons for that. It's not going to happen in the next few years, but over the next 20 years, it's very conceivable. And I think that for investors, long term, gold will maintain itself as a great asset class. Next, please.
Let me interject something. Whenever you talk about the price of gold, you're talking about two different commodities. You're talking about gold, but you're also talking about the commodity in which you're comparing it to, which is the dollar.
Yes, you are.
If gold goes to $25,000, it's not because gold has increased its value. It will be because the dollar has lost its value. And it's very important to focus on that. The Federal Reserve has decided the best way you can cure a debt problem is to go into more debt. Now, I worked it out of my calculator, and my calculator keeps blowing up. We are going to go to far higher gold. I will not pick a price, but I will tell you, you're not going to want to live in a world with $50,000 gold.
Thank you, Bob. And just to go with that thought process, I think this MMT is an important concept for you to in understanding macroeconomic forces, to understand how it's the clever way of devaluing paper money and real assets. I believe that art, classic art, Andy Warhol, Mao paintings have gone up dramatically. So anything that is a real asset will rise during this period. What's interesting to me is that it's the G20 countries as a whole are practicing this, and they work together. So it's very different than 30 years ago when everyone was competing. Now it's synchronized, and this is a very different world. And for you to understand that, it helps you to understand these macroeconomic forces. So gold producers seeing strong profits. This past quarter, September, we're going to see record free cash flow yield for the industry, unprecedented free cash flow yields. And so we're running this analysis of what are some of the cheapest stocks, and many of these stocks we own because these free cash flow yields are so inexpensive. Like Grand Columbia is ranked number 3 in the world in highest grade. So it has the highest, one of the highest free cash flow yields. Eric Sprott was a big investor in there. He traded out, and he's got nothing but a big warrant position as he took his money and went into more speculative end of the food chain. But these other stocks, I think it's important for you to recognize free cash flow is extremely important to the generalist institutional pension fund manager. Next, please. So why consider royalty and streaming companies? They're not responsible for costly infrastructure. Huge operating expenses can be avoided. Hold highly diversified portfolios of mines and other assets, helping to mitigate concentration risk. And they generate the highest revenue per employee of all public companies, and gross profit margins are 3 times the mining industry. They look like a SaaS a technology stock. And the guys like Ray Dalio are shareholders in the Franco-Nevadas of the world. So you get very smart people, the largest hedge fund manager in the world. He's also into this asset class. Next, please. There's another looking at the data points, how gold royalty companies have crushed the overall miners in the past since 2009. You can see here that GDXJ is still negative for this number. The royalty companies are up still 421%. Now the GDXJ's had a spectacular year this year, which is phenomenal for it, along with all the other gold indexes. But the royalty companies as a whole, they seem to fall less when there's corrections, and then they slowly march up as gold prices go higher. And every time there's a correction, they just decline less.
How would you expect miners to perform with either candidate winning or in the event of a general market downturn?
Bob, why don't you give your experience?
Okay, if we have a general market downturn, it will take the miners with it, just like it did in 2008 and 2015 and this last March. But it would be a great opportunity. And from a political point of view, I think it's absolutely meaningless who the president is. We have one snake with 2 heads. And one thing that I would like to point out, we haven't had a chance to bring this up. If you took all of the assets in the world, gold, silver, and mining stocks represent about 1/2 of 1%. If what I see happening comes, that's going to go up to 5 to 10%.
Thank you. I totally agree with them. The great bull market of 2001 to 2007 of gold stocks was gold rising and a rising stock market. You need both. So gold stocks will correct. We saw that in March of this year. February, March, gold stocks fell much greater, but that was the great buying opportunity from those lows. They far outperformed bullion. And I think what's different is the CEOs are much more focused and disciplined on metrics per share, and that will attract more growth fund investors looking for growth in revenue and free cash flow. So I remain extremely bullish on gold stocks. Thank you, ladies and gentlemen.
Perfect.
And thank you, Bob.
Thank you.
Thank you.
Thank you. Thank you, Frank and Bob, so much for being our guests today. I think we all have a lot to consider as we close out 2020 and move into the new year. And we hope you all enjoyed today's webcast. If you have any follow-up questions or we didn't get to a lot of questions, or if you need additional information, please just shoot us an email at info@usfunds.com. Thank you so much for your participation and have a great day. Thank you.
Thank you, Bob. Thank you, Holly.
Okay, thank you.